Good morning, everybody, and welcome to the last in the IMAP webinar series for 2024. Over this today and over the next couple of days, we're going to be looking at issues around less liquid investments and the opportunities that they offer to investors in managed accounts and more generally. I'm delighted to be joined through this series by Adam Myers, an executive director from Pengana, an investment management organization that has a lot of involvement in this type of investment. And before I hand over to Adam, let me just show you quickly a couple of the investments, or a couple of the activities which IMAP will be hosting over the next month or two. So tomorrow, we're going to be looking at private market investments with Fred Pollock from Grosvenor, Hargai Netzer, portfolio manager from Coda Capital, and Nehemiah Richardson from PCX. And then on Wednesday, we're going to try and draw the threads of investing in this type of investment together with Graham Bibby from Partners Wealth and Rebecca Jakes from Mercers. I'll let Adam introduce today's presenters. But later on in the year, we'll have a presentation next week with S&P on understanding the insights that index investing and indices offer for portfolio managers, with Tim Edwards, the global head of index research from S&P, who will be out here in Australia. Tim is an excellent presenter, very funny, and has some really useful insights into what portfolio managers might learn. On the 4th of December, we'll have a single webinar on Asian opportunities with InSync, with GlobalX, and hosted by Nathan Lim from Lonsec. Then in February, after we all come back refreshed from our break, it's an opportunity to showcase the award winners from the 2024 IMAP Awards and then Portfolio Management Conference in 2025. I'm sure I don't need to tell you how to ask a question, and we encourage questions for this session. And so now it's my pleasure to invite Adam Myers to introduce and host today's webinar and the webinars for the rest of this week. Thanks, Adam.
Thank you, Toby. Thanks for the introduction, and clearly some exciting events on the horizon for IMAP. I'm really looking forward to the series. We have 3 panels of the highest quality, and I think that a deep dive into private markets at the moment, private markets and real assets, is very, very relevant. Michael and Mary, do you want to switch on your cameras? That would be great. Thank you. Private markets have been all the rage for the last while, but for the first time, probably since COVID, there seems to be a real sense of excitement about real assets. It almost feels as if the belief has come back to the sector. And so today we'll have an opportunity to explore that with our panel of experts. By way of introductions, joining us today is Mary Power, who is the principal consultant at JANA and the head of JANA's property research team. For those of you who don't know JANA, it's an Australian-based asset consultant with over $1.4 trillion of funds under advice. And Mary and her team are responsible for all property-related matters, including setting strategy and managing outcomes for clients. We also have Michael Sheffield. He is the head of Diversified and Infrastructure Funds Management at Dexus. He has responsibility for over $30 billion in assets, including Dexus's $13 flagship Diversified Real Estate Fund and the Diversified Infrastructure Trust. Michael, am I right in saying you are responsible for about 2/3 of Dexus's assets?
That's right, yeah.
Okay. So as you can tell, he has a broad range of experience across real assets and debt. And joining us next is Campbell Ross, who is the head of wholesale at Octopus Australia, which is a renewable energy fund manager. The group has over 26 billion under management. In Australia, Octopus manages about 1.1 billion with about 10 billion in secured development pipeline. This is a mix of solar, wind, and storage across the country. Interestingly enough, for somebody who is now focused on distribution, Campbell was previously the head of finance and operations and is a real expert on valuation. So anyway, introductions are done. So sticking with ladies first, Mary, can you help contextualize the sector? I know we've gone beyond commercial buildings, but what is the current scope?
Yeah, thanks, Adam. Thank you very much. So, real assets, what are they? So I think if you look up the dictionary, Adam, it says, real assets are real estate, energy, and infrastructure. So we're lucky we've got two other panelists there that are experts in infrastructure, and they have an inherent there's a physical nature, there's a built form about these assets, and there's usually a contract that helps derive the total return from the assets. So broadly speaking, that's a definition of a real asset. Of course, we know property is very broad, and you have commercial offices, as you said, retail, industrial, which are the normal three food groups, but that's very well expanded out now through to, things like medical office, single family rental, multifamily, hospitality, life science, cold storage and data centres, which sometimes can fall between property and infrastructure. And infrastructure, again, as we know, is communication towers, hospitals, energy, power plants, pipelines, transmission lines, utilities. But I think the interesting thing is that you've seen super funds, particularly in the property area now, buying into platforms where they actually own the business, perhaps of a platform. So you own the operating company plus the real estate assets. So that's been a little bit of a change over the last couple of years.
Okay. Anybody else want to expand? That felt pretty comprehensive to me.
Mary's always very comprehensive. I would probably just add that the two, so real estate and infrastructure are generally viewed separately, but what we're seeing, as Mary alluded to, there's a more of a merging of the two asset classes, and in particular, that's where Dexus is really focused, because we've got real estate expertise and we've got infrastructure expertise, and where the two meet, which might be student accommodation, where you've got the real estate and also the business, you've got maybe airports where up to 50% or possibly even more than that might be real estate, and the other aviation related services or income. There's a real opportunity to unlock potential in those assets where those two asset classes meet. And we're finding that globally that's a fairly well established principle, but in Australia it's probably a little bit less understood.
Yeah, on the renewables side, I'd just say there's probably a lot more focus in Australia on early stage development. So that's probably changed a lot. So you're really, projects from an option to lease, greenfield, and then how they move through to construction and operations. Probably in the past, it's been really a focus on sort of late stage projects, but that's now changed, and investors are looking at much early stage projects.
Okay, so now getting into the detail, valuations in this sector are always a concern. We've seen REITs trading recently at deep discounts, which probably allowed the market to compensate for some valuation lags. Are there mechanisms for truly illiquid investments to create some sense of investor confidence in valuations? I mean, Mary, perhaps you can start with real estate.
Yeah, sure. Thanks, Adam. Well, I think so. Well, definitely. I mean, I'll have to show my hand here, and Michael might be the same, but I have got I am a valuer by background, so sort of quite protective of the whole valuation profession in a sense. But I think seriously, we've seen the REITs firstly are highly correlated to the equity markets, so they will perform very strongly and may fall, as strongly as well. So in the last 12 months, we've seen the REITs in Australia actually generate a return of just over 50%. And a lot of that was driven by two stocks, Goodman, that did 79%, and Scentre Group as well, which performed very strongly at about 52%. So a concentrated index, but some very strong outperformers. The global REITs returned something in the order of 26%. Our Australian index is down -9.5. It's got 50% to office. So what does it tell you about the valuations of the unlisted asset class? I would say that we've moved generally to more frequent valuations. So we're revaluing quarterly, but valuers actually need sales evidence in which to undertake their valuation, and that is the legalistic view of how a valuation should be taken. It is always backward looking, and it always has been backward looking, and the courts are aware of that. So I think that what happens in a market like this is exactly what's happened now post-COVID. There's been volatility in the markets. There's been a big gap between buyers and sellers. And as a result of that, transaction volumes have fallen enormously. So hence the valuers are left there with very little evidence in which to undertake their valuations. So I think there's been, so whilst the listed markets can have very big gyrations in returns, it would be very unusual for the unlisted sector to have an enormous gyration within a quarter unless there was an enormous amount of sales evidence which supported that. So the valuations have been, I think, have started to come through. They've been incremental. They've reflected what has been happening in the market in terms of sales evidence, and then they're independent, which is again very important. And I think that the scrutiny by the regulator across the market has really raised the benchmark, and I think that I think the valuers have done a good job in a market where transactions have been very low, although there has been more recently some for them to be able to sort of come to a conclusion about what the correct valuation should be.
So basically, if I'm understanding you correctly, in the absence of sales, investors could still be left wondering, but I guess in a way the unlisted markets are shielded from some of the listed overreactions. Is that a fair summary?
Yeah. I mean, the REIT market drops by 46%, which it did in March 2020. And of course it was, well, hang on, what's happening with the unlisted? There was no sales evidence to support a drop like that. Now the markets have gone up now 50.8% for 12 months. And I haven't heard anyone come and say the unlisted valuations are out of kilter now. They need to go up 50%. So you've got all this movement around a consistency that's happening about what real evidence is available in the market.
Makes sense. And Michael, would this differ in the infrastructure space in any way, where transactions are probably even less frequent?
I mean, it's exactly the same principle. Where there's a lot of noise from the listed market, that will transfer to the whatever sector we're looking at, be it infrastructure or real estate. That noise might also come from the thematics that people are looking at in the future. So when COVID hit, there was a concern that people might continue to work from home, and as a result, there was a selling of real estate, in particular office assets. Now, the valuers are a bit more, I guess, circumspect. They will look at the evidence and they will adjust income. In the absence of sales, they did that from a retail perspective as well. During COVID, they said, oh, this is going to impact quite significantly. Income's going to be down. We'll use a discounted cash flow valuation. And there was about a 20% decline in the better quality assets immediately. So, I mean, there is some scope for valuers to act outside of the sales evidence, but it is limited and it does require some tangible acknowledgement of what's going on. Whereas, as I said, the listed market really can be impacted by a lot of noise and it can overreact. And what I guess is more important is to look at what happens over the longer term. And if listed and unlisted markets join back at some point in the future, you can look at the volatility in the two markets and you can say, well, in my view, given my investment horizon, who was right and who was wrong? But I think it is a little bit more horses for courses. If you want liquidity, then obviously you're probably going to get that out of the listed market, and that means that people who want liquidity are also going to be selling, and that is probably going to have an impact on the pricing of those listed stocks that they're selling as well. So yeah, it's there's a lot of noise, and it's a little bit more complicated, but valuers are trained in valuation. So they're using evidence and they're using their skills, whereas the listed market, anyone can trade, and that influences the price.
Yeah, I very much like that horses for courses analogy. So Campbell, if we consider that, do the benefits of investing in real assets outweigh that lack of liquidity?
Absolutely. Providing, I think, that the returns and the risks are properly understood. So real assets are typically uncorrelated to market movements, and that can be incredibly valuable. If you think about renewable energy assets in particular, the asset characteristics of those, so you've got a free and forecastable fuel source, sun, wind, really attractive sort of revenue profile and sort of low operating costs. And so in terms of sort of portfolio allocation, they've got a low correlation to other asset classes, defensive income. Often for operational assets, you'll have long-term fixed price, inflation-linked power purchase agreements with investment-grade counterparties. So these assets are sort of a natural inflation hedge as well. So yes, certainly there's a lot of benefits in these assets. And then for me, liquidity, it's about understanding investor needs. And so a good wealth manager or financial advisor will know what their clients need to live, what's going to drive value for them, or what's the value they need sort of over the long term. And then lastly, what are they actually interested in and what excites them? I think those three things are really important. And then knowing this, they can establish what percentage of a portfolio they should be comfortable putting into more liquid assets. And then obviously it all comes back to sort of diversification.
Okay, so you spoke quite specifically about renewable assets there. Mary, maybe you can sort of expand. How important is diversification across the sector as a whole, and how easy is it to obtain?
I think we probably all agree diversification is important, because we're never going to get it all right all the time. And I think it is important. And I think the COVID situation is probably a great example, and others might like to comment. Michael will have a view, I'm sure. But would we be having this discussion about office now or in the last year or two if COVID hadn't happened? I'm unsure we would be. It had been a very strong performing asset sector within the property market. It had attracted offshore capital very strongly into the sector. It was it provided you with an ability to get set in quite a sizable amount in a particular asset. And the market here in Australia is quite transparent. You can do your due diligence and you can assess assets. Now, obviously, office has had a very difficult time in the last couple of years globally, and as a result of the working from home. So, if you had 100% of your portfolio in office, you would have probably done pretty well for 10 years, and then you've hit this difficult point now. So I think that diversification, that's just an illustration of why we think diversification is important. And I think you will get different drivers in different sub-markets. Now, particularly, you'd say Sydney's been a very strong market, very strong. Brisbane's has been a strong market of late. Victoria, not a strong market. And then you'd head off to the US and you'd say there's so many sub-markets in the US across the 52 states that there's a lot of different drivers going on within those various states. I came back from an overseas trip and said, I'm never going to make a sweeping statement about multifamily ever again, because the subsectors are just, and the drivers for that particular subsectors, and that's just not even just what's built across the road, but the insurance rates and the tax leakage in those particular sectors before you even get to the built form is just so different. So I think we have seen the US in the last 12 months has actually outperformed Australia. So we think that, you know, having a little bit of money in various parts in globally is strong, but is a good idea. But even within Australia, I think diversification is even if it's at the sector level, it's very, very important.
Okay, so you've been speaking a lot about diversification within the real asset segment, but from a whole of portfolio perspective, do these assets provide true diversification, or is a part of it really just because the valuations change more slowly that they appear to be more diversifying?
I would say that both to some extent. I think, yeah, the valuations are a point. If you look at equity crisis points, whether it's, you know, the 1987 and, you know, the early 90s, and you will see that, you know, equity markets went down considerably. You'd be hoping that your real assets or your property assets, and certainly infrastructure has been a great example, and I'm sure Michael will talk to that about this over this COVID period. It really hasn't missed a beat. And, you know, the unlisted property has given a good diversification to that equity market risk. And so as a house, we generally don't have a lot in REITs. We have a little bit, but we would say we're trying to get that whole of portfolio diversification from having some unlisted assets.
The real asset sector is, as Campbell was saying, is often underpinned by very secure income streams, and the volatility often comes around the valuation or the trading price, rather than you know, the I guess typical investments in equities are more volatile as I guess a principle that their income stream is not locked in as much as it would be in a real estate asset with potentially you know, hundreds of different tenants. So the tenants, by virtue of having lots of them, means that they're diversified. And infrastructure is often backed up by very secure contracts or income streams as well. So what I often see in the real asset space is incredibly stable income, not always, but often very stable income streams. And that is a good diversifier in itself. If you're focused on income, then, you know, these asset classes are typically a very good way of getting that income. And they're also, as Campbell also mentioned, they're also often a very good inflation hedge. So depending on what your objectives are, then, you know, real assets can be a very good way to secure those income streams and the inflation hedges. I think that there's also very different, I guess, risk profiles within the real assets. So, you know, you can get diversification at the asset level, the sector level, and the geography. And as Mary was saying, the geographies can actually have very different results depending on where your investment's actually located, and similar at a sector level, depending on what sort of investment within the real asset space you're invested in. That can actually you know, produce very different income streams. So once again, you kind of really got to know what you're trying to get out of the asset class, and then look at what investments are actually going to provide that, you know, the risk return that you're after.
And Michael, the natural buyers, super funds, I assume, are there other dominant buyers in the space?
Oh, I mean, I think they're very, anyone can buy into the sector through the listed market. There's limited options in Australia for pure play listed, well, all real assets, real estate and infrastructure. There's not actually that many ways that you can get access to the sector, but there's certainly you know, direct access through various funds or ways that you can get access. Super funds, I think someone else alluded to it, are getting bigger in Australia, and they're often buying businesses outright. So they will have exposure to the business and also the underlying income or underlying assets. So super funds, I think, are dominating a lot of things at the moment as they're getting bigger and bigger, and there's still money flowing into the sector, but you can get access to it regardless of the size of the investment.
Great. Now I'm keeping an eye on the questions as they're coming in, and we literally are receiving dozens of questions. I'm going to try and work them in with my own questions as well, and see if we can make sense of it that way. The use of leverage obviously magnifies returns, but also increases risk. What are the considerations that you think about when applying leverage? And the key question is, does it differ between sectors? Does it differ from real estate to infrastructure to renewables? So maybe we'll start with you, Michael.
Yeah, look, it certainly does. You can have a very secure income stream in infrastructure, which is geared, I don't know, 95%, versus a less secure income stream, which you may not want any gearing. I think the thing that gearing introduces is volatility. So the gearing return, or the debt, needs to be repaid regardless. So you've got a layer of or capital that needs to be repaid, and that means that your returns are supercharged both on the upside and downside. And that can be fine when the market's going up, but as we've seen recently, when there are downturns, it does make it difficult for particularly unlisted entities to fund cash flows going forward. So you need to be careful about gearing, and when you introduce gearing, you introduce additional risks, but you also shy away from the pure play exposure that you're looking at through the the investment that you're making. And we have seen quite a lot of examples of funds which were offering liquidity, and then there's a downturn hits and they are no longer able to offer that liquidity because gearing goes up and it's more difficult for them to service debt requirements. And obviously that has implications. So I think I prefer low gearing, because what I'm after is generally pure play returns. If you want those supercharged returns, sure, gearings are good, but you really need to understand the risks that you're introducing into the investment.
Yeah, and just on that point, you increase the gearing, you're pushing the risks up, as Michael said, into opportunistic almost. And if you ask 5 investors what level of gearing you want, you'll definitely get 5 different answers, I would say. We always look at the unlevered IRR as Michael would do for a particular investment. So, scrape all the gearing out and just look at what the real estate asset actually delivers without any gearing.
Makes sense. Campbell, I now have a series of questions I would like to ask you about the transition to net zero and the opportunities it creates for your sector. Maybe you can start and give us a bit of an overview of the opportunities, and also perhaps sort of allude briefly to how they can be exploited.
Yeah, sure. So yeah, I guess it's worth saying, so we're a renewable energy fund manager, as we said at the start. So we're really working on building a portfolio of solar, wind and storage across Australia. So the mandate is Australia specific. And the reason for that is the Australia energy transition thematic is quite unique to the rest of the world. You've got Australia's current energy mix, the majority being fossil fuels, so coal and gas. These coal plants in particular are reaching the end of their 40-year economic lives. They'll be closing over the next sort of 10 years across the country. There's no additional investment going into these assets. The older plants we're already seeing breaking down, which causes huge spikes in prices across the country. And you've now got difficult situations where the government is having to step in and support Origin, as an example, to run Eraring, which is Australia's largest coal plant, out until 2027. So you've got this huge supply coming off in Australia. And then on the other side, you've got the transition to net zero and the electrification of everything, particularly in industry. So thinking electric vehicles, data centres, AI, longer term green hydrogen. These, are all expected to see the demand for energy in Australia double over the next 20 years. So where I think the real opportunity is, and for us, in our space, it's it's all about the right strategy, and the strategy really is, you know, those that can come in and build a portfolio of assets across the different states, solar, wind and storage, to replicate that shape of coal that's coming off. If you think about now, coal can build out during the day. You really want to be able to step in those hours where there's low sun, no sun, minimal wind, and you can step in and provide renewable green megawatts during that period. So those that have the ability to get projects through development all the way through to operations over the next few years, and then can provide that firm block of green power, are those that will succeed in the space.
And to what extent do these assets rely on government subsidies to be viable?
Yeah, we see a lot of supports from government across the industry. So specifically, renewable energy sites receive large-scale generation certificates. Currently, that goes out until 2030. And then after that, there's what's going to be called REGOs, which are Renewable Energy Guarantees of Origin, and they'll go indefinitely. Both schemes sort of provide additional revenue streams for renewable energy generators, as those certificates can be on-sold. We also see government step in and help de-risk development projects by providing the routes to market, the power purchase agreement. So that is the case with our latest project, Fulham. Fulham's a solar and battery project in Victoria that was successful in what was the VRET 2 tender. So it's got a power purchase agreement backed by the Victorian government, and we've developed this project from an option to lease all the way through to breaking ground. It reaches FID next month. So that's the way governments are supporting, and then obviously transmission build out. All of that is where governments are doing a lot of the work. And yeah, positively, you know, the transmission that's required over the next 10 years. 50% of it's already committed and underway. So while there's a lot to do in that side of things, you know, it is happening, and I think state governments and as well as the federal government know that, you know, renewables are proven technology. They're cheapest, and ultimately with batteries, you know, they can replicate the shape of coal. So the support's there.
And so, do you think that the return on these assets, would you expect the return on these assets to be different to traditional infrastructure assets?
I would. So I think baseline is sort of core plus sort of value add infra funds, and so I'd say they typically target high single-digit returns, and I think that would be with a higher allocation to probably operational assets. As I said a couple of times, probably what's really important is having the right strategy, and I think the right expertise in that space. So we sort of have a really dedicated team, 55 Australian energy professionals, you know, boots on the ground that understand these things. So to enhance your return profile, you need to have those internal capabilities, and you need to be able to invest over the life cycle of these infrastructure assets. So that is development and construction. So I think when you look at sort of our strategy and being part of it from early stage all the way through, sort of looking at a return higher than those single digits, we sort of target sort of 10 to 12. We've achieved that since inception of our fund, which is great. And the returns to date, you know, are pre what I would call sort of long-term alpha, which we actually expect from the strategy. And that's what I talked about just before, that sort of portfolio approach, and how do you bring all the assets together across the country to replicate that shape of coal. So yeah, I'm obviously bullish on space.
Michael, do you have any perspective vis-a-vis the traditional infrastructure?
In terms of access to...
Well, in terms of expected returns and how they would differ between real assets and traditional.
I mean, I think that it depends on the risk profile that you're taking on and your expectation of how your income stream is going to be growing. So I mean, I think, you know, for core assets, we're talking 6 to 8%. For core plus, we're talking 8 to 10, and for value add, we're talking 10 to 12%. So that depends on the risk profile that you're willing to accept. But then on top of that, I think the thematics come into it. Where do you think the growth areas are going to be? And then, you know, channel your money into those areas that you think are going to outperform over the long term.
Makes sense. We've got a good question that's come through here from an anonymous attendee who's asking if Australia is a potential renewable superpower compared to, say, Morocco or Saudi Arabia, and at comparable cost.
So I think Australia benefits from having massive amounts of sun, wind, and land. So do I think Australia can and should be a renewable energy superpower? And yes, absolutely. Because I think, you know, the opportunity is there to build these out at large scale, and there is an industry in place to do that. So I'd say yes. Definitely, we're going to see a lot in this space, and it's needed, you know. So with it, as I said, with coal coming off, something needs to replace that baseload power, and you know, renewables are the proven option for that. You know, obviously there's a lot of chat about, well, not a lot of chat, but there's chat about nuclear and things like that. But obviously comes with a whole bunch of other challenges in terms of cost, timing, and other risk factors. So the answer, I think, is yes, we're well geared up in Australia to really be a world leader in this space.
Great, thank you. We've received a number of questions about the implications of a Trump presidency. Inflation is a concern. Is there going to be fiscal offsets? To what extent do we have to consider tariffs when talking about real assets? Who wants to start?
I mean, I would just say, who knows, to start with. You know, Donald Trump is known for his, I guess, art of the deal. So he will put forward a position which he not necessarily is intending to follow through with, because he's looking to enhance his negotiating position. So, you know, he's talking about tariffs 60% with China, 20% with the rest of the world. Will that happen? I don't know, but it's likely that tariffs will increase, which will increase inflation, which will lead to interest rates remaining higher than were anticipated. And we're already seeing the impact on interest rates there. They've gone up quite significantly, and the expectation of rate reductions has, definitely gone away this year, but certainly been pushed out, you know, quite a way in terms of Australia. I think you're already seeing China talking up our Prime Minister as a very good example of what a Prime Minister is. And don't forget, their currency is a very efficient way of adjusting the pricing power of different economies as well. So look, you know, there will be impacts, and the reality is, until the policies are in place, it's very hard to know what the impacts will be. But we are seeing quite a lot of very, very significant appointments within the Trump administration. So it looks like you know, there is going to be significant change on the horizon.
I like that point about currency providing the buffer, the adjustment factor. Mary, I think you interrupted you.
Oh no, I similar. I think everyone thinks that it's sort of uncertain. You know, some of these initiatives are obviously pro-inflationary, but I think it's uncertain as to what the reality will actually be. But I think it's probably worthwhile saying there'll be disruption. There'll be disruption of trade, which, you know, there's been a lot of onshoring, you know, and we've seen that over the last couple of years, which has driven a lot of industrial returns over there. And I think that will definitely continue. But and it was interesting looking at the press on the weekend that Warren Buffett is selling out. So that was another interesting part to the puzzle.
Yes. Sorry, Adam, specifically to renewables, I think it's no secret that Donald Trump's probably not pro-renewables. So it's going to be interesting to see what he does from a global lens in terms of supporting it. Albeit Elon Musk being very close to him is a bit of an anomaly in that sense. But for us, like, I think that there's going to be some noise, but probably more at a global level. And I think you'll probably see a slowdown of maybe some developments globally. But in Australia, you know, we're going to continue to build out renewables. So I think it could actually really benefit. You know, if you're not competing with other projects globally for labour and the cost of kit as well, I think could really positively impact projects here. So yeah, I think it's going to be more noise than anything else when it comes to the impact on renewables here in Australia.
Okay, so with that in mind, how do you compare local and global opportunities? Mary, where would you be allocating your next dollar?
Well, that's a good question. So I suppose I can tell you what we have done in the last 2 years. So we travel extensively, the whole organisation, every asset class, and we discuss things across the business, obviously. We went to Europe last year, looked at what the valuation declines had been and what the ability to buy something heavily discounted was and the quality of the assets, and we put money to work over there on an opportunistic basis. So it was not core real estate, it was opportunistic, attractive in a dislocated market. No one else was, there were very few that were able to buy in that market, and the discounting was quite high. And as we all know, the entry pricing usually sets up what your total return's often going to be within an asset. So we were quite attracted to that. We've actually invested some money on behalf of clients into industrial. Well, we've done that a lot over the last couple of years, but more recently in Australia. And you know, we're looking at a lot of different opportunities at the moment, and even evaluating the office sector, because of course things can be oversold. And I'm sure Michael will be looking at the office sector as well, because
I'm nodding.
because when there's a lot of, you know, there's a lot of noise and a lot of negativity, that's where you should be looking. So big emphasis on underwriting, getting the cash flow and the, you know, the rents and the tenant demand outlook. And I think the living sector is probably another area that will be, there's a global shortage there. So that's another area, and Michael's already touched on student accommodation, which is just a form of living, as is retirement villages. Aged care's got a fair bit of regulatory risk there. But, you know, I think all things living will be up for evaluation.
And to your point about the future returns relates to the price you paid, we have a question here on to what extent your view on valuations being held up by unreasonably high market rent assumptions is coming into play.
I presume that that's really talking about the office sector, which obviously has a high level of incentives within that sector. And if anyone asks me what would I be most nervous about, it would be the incentives around office. And because I lived through the early 90s, and the incentive levels were high, but vacancy was very high in the early 90s. So with the exception of Melbourne, we haven't got the level of vacancy that we had then. And the other thing is we probably haven't got we're probably not going to have a recession, we hope. And that's what happened in the early 90s. It is you know, base rents are what is how the market works. And the cap rates are applied to the face rents. The face rents are virtually in place because you actually need money to entice people via a fit out. But some of these more extensive ones are a reflection of perhaps the higher vacancy levels at one end of Melbourne as opposed to the other end. So it's, again, very subsector specific, but yeah, they are something to be taken into account for sure.
So would you be wanting to see those incentives?
Oh, absolutely.
Come
Yeah.
down before
Yeah.
you consider?
The sleep at night rule is to have the incentives at 15 to 20%, not at 45%.
I was just going to say, I think that the market is very divergent at the moment, and in some assets there are, you know, we're doing better than what the valuations were anticipating. The incentives are quite low, and the growth is coming through. And if you look at the, you know, I guess the reality of office space, there's the employers are wanting people to come back into the office. The employers are also, they recognize that the cost of labor is actually quite high, whereas the cost of rent is low in comparison to wages. And if they can get more productivity from their employees by getting them back into the office, that's what they're going to do. There's been a bit of a balance of power, which was in favor of the employees rather than the employers over recent years, but that seems to be shifting, and we're seeing more and more employers wanting to get people back into the office. But if you just take a step back and you say, okay, let's look at the office market. The Sydney CBD, for example, is constrained. The cost of construction is going up, and we've got really strong population growth. So if you put those things together, there's an expectation that people, there's going to be more white-collar employment growth and more people coming into the CBDs. And to justify a new development, what I look at is the economic rent. So the rent that can justify putting the cost into building a building is actually, and I'll talk generally, is generally higher than what people are paying at the moment. So that means that there's a bit of a time when you're going to get rental growth while those two catch up, because the cost of construction has gone up, you know, a huge amount over recent years. It's just, it's incredible how much it's gone up. And there's actually been quite a number of builders disappear from the market as well. So to bring that stock onto the market at the same time when we've got a shortage of residential you know, houses, we've got a shortage, we've got infrastructure works which are being rolled out across the country. You know, there's that demand for the building works to happen, and there's a lack of builders. So, you know, if you put those together, the prospects for the office market, for example, are quite positive. And, you know, it's a similar story with retail. When COVID hit, everyone says, oh, it's negative, there's going to be online shopping, people aren't going to go back to retail centres. But we're seeing growth in retail assets at the moment. And, you know, our expectation is that you're going to see that continue, because once again, we've got strong population growth, and the retail assets, which are located in, you know, there's what we call, you know, oh God, I forgot the word, but anyway, the dominant areas, the dominant trade areas. Catchment area, that's it. Yes, they're going to do very well out of the population growth, and the fact that there's going to be development required in those areas because of the population growth. So, you know, over time, I think the outlook for retail is very positive as well. And then industrial, you're servicing an increased population, so that's relatively positive. And infrastructure, as you've got population growth, you need to service the population as well. So there's an expectation that there'll be continued demand for infrastructure build outs. So, you know, I think if you look at that, that's a very positive long-term story. What you need to worry about is the short-term noise around that.
I think also, just adding to Michael's discussion there, Adam, is the fact also, and picking up on the net zero, is there's a bifurcation in assets between those that are, you know, have got great ESG credentials and those that haven't. So the incentive levels, so the universe is actually shrinking. So alongside all this difficulty in building, which is going to, you know, reduce supply, the supply is also reduced by this overlay of ESG, which not every building can actually rank, you know, quite highly on. So your incentive levels for the towers that rank really well will be a lot lower than from some of those older, well, not even just older, but assets that can't meet that criteria.
No.
Yeah, there's buildings that people want to be in, and then there's buildings that people don't want to be in, and they just don't want to be in those other buildings for ESG reasons, or, you know, they're too far out of the CBD, so it's, you may as well work from home, because, you know, if I've got a meeting, I'm not going to spend 30 minutes walking, you know, to where the meeting with my trading partner is. You'll just, you know, log on and do a Zoom call anyway. So yeah, there's definite buildings and markets that are going to outperform, and there's ones which will underperform.
I think that's a really good perspective from sort of nuts and bolts logic, sort of ground up logic. So that's great. Thank you. Changing text slightly, What is the impact of AI and advanced robotics? What do you expect the impact of that to be on real estate? Office, obviously, it'll have an impact. Industrial, I think it's pretty broad. So Michael, maybe you want to kick us off with an answer to that one?
Well, yeah, I mean, we're only starting to see the beginning of what AI is going to do, and it will have a huge impact. I think it'll have an impact on certain types of workers, but not all types of workers. You can't use AI for manual labor, for example, or nursing services, for example. There might be aspects of the roles that you can, but not all. So, you know, it is probably more of an issue for the buildings which have got large tenants, so like large accounting firms, for example, or large exposures to very large law firms, for example, because they may be able to reduce their workforce. But where you've got buildings which are diversified, which we were talking about earlier, and they've got a variety of lots of tenants, or we call them customers in them, they're probably going to be less impacted. There's obviously the data center angle, and data centers are servicing AI, and that means that there's an increased demand for data centers, and also energy, because the energy consumption within data centers is quite significant. So, a play that if you're looking to ride that AI wave might be to get more exposure to data centers and energy, but there's obviously chip makers who provide more of a direct exposure to those kind of trends that are playing out. I guess there's also certain risks around that. So Microsoft, for example, have been trialing having data centers within the ocean. So, they've then got access to cooling, direct cooling, rather than having to use energy to cool. And then they can also use, for example, wind turbines above the data centers to provide some of the power. And if they're close to the coast, then you can tap into the networks. So there are some risks, but I would, I would say that there's probably going to be a lot more demand for those sort of services than there will be taken away through what new technology brings about. There's just going to be an incredible demand on data and energy over time. So I think that's a positive for those kind of areas. I mean, retail may be impacted, but we need to see how that will all play out going forward. So there's quite a lot of uncertainty about how it will impact, but the one thing for sure is that it will have an impact, and it's really important to stay very close to the trends so that you can identify them soon and then adjust your investment style or investments to actually make sure that you're in the right spot at the right time.
I think being very close to your tenants as well, because their individuality of various, disciplines are going to be, you would hope, be forward-looking as well. So, they've got to plan out their space usage for 5 years or 10 years when they sign a lease. So, hopefully, and I'm sure, you are, but just being close to those tenants and their customers and what their future requirements are going to be.
I guess it's very much like the example you gave about ESG, that there's certain buildings that are going to be in demand and certain buildings that aren't. There will probably be definite winners and losers from the space. The AI recipients, obviously the winners, but potentially if you've got an industrial factory and now there's automation that can work 24 hours a day, etc., there might be less demand for premises there.
Well, that's really interesting, because I'm not sure about if there's less demand, but there's certainly a lot of the tenant cost going into these sheds, often, hundreds of millions of dollars, which means you've virtually got that tenant for quite a long time. They're not going to spend that amount of money and move out in 2 years. So that's a great example of where you get a tenant and a security of income for often well past your lease time, if it's a newer building that can accommodate that sort of infrastructure within it.
That makes sense. There's a question here, and it's a bit left field, about tokenization being used to create secondary market liquidity. Apparently, it's sort of taking off in overseas markets. Has it reached our market yet?
Well, I think liquidity is a big issue for unlisted assets, because I think when you have a market downturn, everything's illiquid. But you can have an illiquid listed stock as well. So I think illiquidity is, I think there are times in the market where things are liquid, and there are times in the market that things aren't. And I think, you have to really just be observant of what the environment is at the time. And, I think it can be, I think liquidity is instantaneous liquidity in an unlisted area is difficult, I'd say.
Yeah, I would agree. I'm not sure. There's a group called Primary Markets in Australia, and if the fund is signed up to it, they do provide some liquidity options on the secondary unit market. But depending on how you hold your investment, there may or may not be liquidity options in the unlisted space. If you hold a substantial amount of unlisted units, then you can often sell them in the secondary market. And this primary market service does, as far as I know, offer that to smaller unit holders if the fund is signed up.
I think, what Mary said, you need to understand what's the liquidity for, and will the liquidity be there when you need it? Because the nature of these assets being illiquid by nature, you can manufacture some form of liquidity, but you've got to really think about what will it be when push comes to shove.
Mary, you mentioned build to rent accommodation earlier on. Is build to rent likely to be viable going forward, given the low yields in this asset class?
I think the answer is possibly yes. It's a highly developed market in the US, highly developed, and it's been functioning and well functioning for many years. I would think that Australia is possible. It's just Australia is a lot smaller with a lot less sub-markets than what the US has got. But as I said, housing affordability, it's a big issue. Is everyone going to be, there's not enough roofs over people's heads for them to be able to naturally move to household formations like they are in the US. So as as kids get older, they want to move out of home and they can't buy a house, they're going to have to be able to rent. So I think the necessity is there. I think has there been a reluctance? I suppose there has been a reluctance to some extent. People have been unsure about the property metrics, I would say, to be absolutely honest. The metrics in the other asset classes, and again, it comes back to validity of the valuations and those sorts of things. Super funds have got to do a lot of things to make sure to keep the regulator happy in terms of how they're holding assets. And we're lucky we've got great performing fund managers across Australia that make sure there's independent valuations, and we can discuss those with them and scrutinise on those sorts of points. But the issue is that there hasn't been a whole lot of sales and transactions of build to rent that actually clarifies how the metrics are working, whereas the US has got a significant amount of turnover.
Right.
I'll just add to that quickly. I mean, at the moment, mum and dads tend to have a lower cost of capital than the super fund, so they're willing to invest in an investment property, and they don't expect the returns that a super fund requires. So that makes it difficult at the moment. And as Mary said, if you go over to the US, it's a cookie cutter approach. What rent you're going to get, what is going to be demanded by the market, what the cost of managing it's going to be. It's all very, very, very well tried and tested. In Australia, it's relatively new. So to put the investment in, you're taking a higher risk because you don't know what the demand in the market is going to be. You don't know what it's going to cost to manage it exactly. You're taking on all these risks that you wouldn't in an overseas investment, and that will take time to work through the system so that people do really understand, you know, what the risk return profile is that they're getting themselves into.
And it's not in the benchmark, Adam. So it's an off benchmark risk. So that's another hour's
consideration.
discussion.
We don't unfortunately have enough time for any more questions. There still are dozens of questions that are coming through, many that I would like to ask, but unfortunately we have run out. So I found this conversation fascinating, a lot of optimism grounded in real facts, which was great. So I just would like to remind everyone to join us again tomorrow, same time, same place. And Toby, I think over to you for the close.
Yep. Thank you very much, Adam. Look, like you, I found this. I mean, with the depth of knowledge that Mary, Michael, and Campbell bring to this this investment market, such an important one for us. It was a pleasure for me to listen in, and I'm looking forward to tomorrow to Adam, you coming back to join us with Fred Pollock from Grosvenor Capital Management, Hargai Netzer, known to many as a leading portfolio manager at Coda, and Nehemiah Richardson, talking about PCX as we drill into the illiquidity considerations around private market investments. And then on Wednesday, with Rebecca and Graham, we'll draw together the threads specifically from the point of view of portfolio construction and thinking about this, both property, private markets, and other less liquid investments from a portfolio manager's perspective. So thanks very much for joining us today. We'll look forward to having you join us again tomorrow. Adam, thank you. Campbell, Michael, Mary, thank you very much.
Cheers,
Thanks,
everyone.
Toby. Thank you, Toby.
Bye.
Cheers.